Last week we saw some rotation out of the Magnificent Seven in the S&P 500 into other industries, and in today's focus we are looking at 5 of the best undervalued dividend stocks with a ton of upside. Now these are going to range from high yielders to ratings which have very strong buys, and we're going to jump straight in with the first one, which is Darden Restaurants. Now this is one that is unfortunately down around 15% over the last 12 months. It is trading towards its 52-week close, but we do get that buy rating from Wall Street, fairly strong as well, 4.1 out of 5. However, the other two analysts do give this a hold. It has a very nice forward yield that is near enough at that 4% level, and when we look at the forward P sitting at just under 15, S&P right now sitting around 23, but as always we will look at the sector for that relevancy. Now if you've been holding this over the last 10 years, the good news is you would have significantly outperformed the S&P 500, you would have been up around 258%, and we can see not too long ago it hit its all-time highs at just under $180. Now when we take a look at this company, it does have a safe dividend score of 70, which is always great to see. And we also want to let you know that it was just reaffirmed just last week that their dividend is safe and a dividend cut for this company is unlikely. Now in terms of the last recession, for those that do see one inbound, well, Great Recession 07-09, they in fact increased the dividend. They had marginally better growth than the S&P, -1 with the S&P around -12, and they also marginally outperformed, -44, as we can see the S&P -55. Now one thing we really like about this company, very nice increase just last month at 6.9%, well above that average 4% inflation that we always like to target as a minimum. Over the last 5 years and over the last 20 years, very strong double-digit growth. And on top of that, we do want to point out that they have been increasing those dividends for the last 3 years. During COVID, no surprises for this industry at all. The majority of them did either maintain the dividend or cut it. But as we can see, since then, they have started to aggressively increase that dividend. As always, we like to take a look at dividend yield theory on this channel. Now, it does state a company is undervalued when the current yield sits above the 5-year average. We have our first sign of undervaluation here on the yield. We also have another undervaluation signal. Forward P sitting at 15, that is below the 5-year average of 17.9. And when we do take a look, it isn't too dissimilar from the consumer discretionary of 13.7. Bear in mind, we don't look at any of these models in isolation. We will conclude towards the end when we do take a look at it in the valuation model. Free cash flow payout, as always, we focus on this and we want below 50% for this industry. My personal blanket rule, below 60%. Over the last 3 years, it has straddled around that, pretty much straddling around it over the last 10 years. We do see that COVID year, no surprises then why they did cut that dividend, but since then it has been pretty much around the 60% level. Nice to note that is one of the reasons why we do see a safe dividend score. As always with free cash flow, we want increasing free cash flows that are consistent over the longer term, and I'm actually genuinely surprised. This is actually very strong for this company and the industry. Granted, we see the drop in 2020, but over the longer term, not only is it moving in that right direction, but over the next 12 months, that is expected to continue. In terms of sales growth, well, as always, when we do the deeper dives, 3 to 7%. No surprises here. Look, 2020, 2021, the majority of this industry really suffered with the restaurants, in fact, closing down. So we have no shocks or surprises here. Over the last 2 years, 9%, very good to note. In terms of numericals then, well, we see it nearly double over the last 10 years. And whilst we do like to talk about returning excess cash through those share buybacks, whilst Darden Restaurants do this, in fact, we also note during that COVID period they issued shares. We do see over the longer term it has moved, although fairly trivial. When we look at the ROIC, remember for this very important metric, 10% or more give us faith management are able to effectively allocate their capital. 12% for this industry specific. Over the last 3 years, very strong. Granted, it has rebounded from the 2020 position. Before that, though, we did see it in the high 20s. Overall, 14% over the last 3 years, very attractive for potential investors. We then move on to the operating margin. As always, above 16% for this industry and pretty much generally across the majority of industries. Now it is lower than that. The only thing we would say as a positive, it has had some operating efficiency increasing over the longer term. In fact, going from 6% to 12% in the more recent year. In terms of the free cash flow margin, fair to them, they are very strong, in fact above the minimums over the last 4 years, and again really only seeing massive trouble or below that in 2020 in that COVID period. We then move on to the net debt to EBITDA. Why we like to focus on this metric correlates to dividend safety, balance sheet strength, earnings before interest, tax, depreciation, amortization. The numbers below, number of years it would take the company to pay off all of their debt net of cash on hand. Below 3.5 for restaurants, and look, 2024 pretty much on that level right there. We want to see it lower. Nice to note, over the next 12 months, that is exactly what they're looking to do, and it is looking to be considerably lower. So a very good sign. It is moving in the right direction. Now we move on to the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Our intrinsic value at $187. How we got here? Well, we've used all four models. In our deep dives, we do run through all the inputs and outputs that we use for each one of these models. Today, we're getting straight into it, and at 187, there is a nice margin of safety. Remember, we start off with 10%, execute on that if it meets our three golden criteria: wide moat, strong financial metrics, good forward-looking data. Now, if you believe that in today's episode, a buy at 168, then we keep going till it's near the current trading price, and in today's episode, not at the 25%, but really not that far off. So based on our estimates and judgments, somewhere between 20 to 25%. In terms of Wall Street, well, I also see some very nice upside, 24%, their price target $176, and this is definitely one I would say to consider for the portfolio. Nice margin of safety, nice upside, as well as a very nice forward yield as well. But as always, let us know your thoughts as we go along today. Before we move on, just to let you know, we have released our latest free weekly article. This newsletter does come with a free spreadsheet as well, runs through a lot of dividend kings, our buy prices, whether or not we like them. But as always, by clicking below, you can get instant access to all of these other articles as well. And we are looking forward to Monday's article where we are running through some very good looking dividend aristocrats to buy. The next company we're looking at is Delta Airlines Incorporated. Now look at that, a double strong buy rating, Seeking Alpha and Wall Street, and a buy from Quant. This is trading now in the midpoint of the 52-week range. It does have a yield lower than Darden Restaurants that we can see here at 0.9%. In terms of the forward P, just under 7, so it does look relatively attractive on that metric alone. And over the last 12 months, down 9%. Over the last 10 years, it is up around 19%. Still hasn't got to the highs pre-pandemic at around $62, but hopefully it does look like it is moving in the right direction that we want to see. And this one has a ton of upside, as we're about to find out. Now, unfortunately, it doesn't currently have a dividend safety score due to the fact that they just restarted that dividend, but we can take a look at the supporting metrics to give our thoughts and analysis. In terms of the dividend, well, over the last 5 years, given that during COVID they did cut that dividend, we do get that negative 26%. But over the last 20 years, it has increased by 9%. Always a good sign, especially when they have restarted that dividend, as we can clearly see. We would expect them to ramp that up fairly aggressively. In terms of taking a look at the free cash flow payout, one of the reasons we do believe they will increase that dividend at a very aggressive rate, well, 2023 at 17%, over the next 12 months at 11%, does give them a lot of room. Definitely one to consider, especially if you are looking at a very nice dividend growth company. No surprises here, 2020 to 2022, due to the pandemic, we can see they have suffered. Nice to note it has rebounded, not only very strongly in 2023, but look at that, over the next 12 months, it is expected to increase very, very rapidly, pretty much to the highs that we haven't seen since 2019. Then when we take a look at their sales growth, what is nice to note, post-pandemic, we see some very strong numbers. Even in 2023 at 15%, that is a great sign, and we do expect moving forwards that this industry will recover very sharply, as we can see just from 2021 and 2022. In terms of numericals, well, from that dip in 2020 to 17 billion, it has recovered very sharply as well, and has in fact increased over the last 10 years. On top of that, shares outstanding, something we mentioned earlier that we didn't see from DRI, is that they have been doing share buybacks, although we do note over the last few years it has slowed down quite considerably. Definitely something we can look at their investor presentations if that is something you are interested in. In terms of the ROIC, looking very strong over the last 2 years where it has recovered. Before that, though, we do note it was sitting very high. Again, this is showing some very nice metrics, even after the issues that they did have in 2020 to 2022. But again, that wasn't just this industry specific. In terms of operating margin, well, we do note it has recovered to around 10% in 2023. Ideally to the pre-pandemic levels, around 15-16% would be where we want to see this over the next few years. And in terms of the free cash flow margin, 2% in 2023, again, something just to keep an eye on, ideally back to 5% at a very bare minimum. Finally, the net debt to EBITDA, always important. It tells you two things, as we said earlier, and what we do know, 1.95 in 2023, expected to go lower over the next 12 months. Again, balance sheet looking very good, and in fact their dividend safety, whilst we don't have a score, when we compare the net debt to EBITDA alongside the free cash flow payout, this would be sitting at a very safe or safe score. We then move on to the valuation of DAL. Well, our intrinsic value at $68. Also bear in mind you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers whether it's this company or another. Again, this will show some very nice margin of safety. 10%, well, I buy at $61. 20% at around $54, at 30%, again, that is a very nice margin of safety, especially if you believe this is a high quality company and will do very well over the longer term. 35% margin of safety. As we said, not only did we have a double strong buy rating, we also had a buy from quant, not something we always see, and we have upside of 45%. Whilst their price target is slightly lower than our intrinsic value, you can clearly see that we do believe this is a very strong company to consider in the portfolio. We then move on to a real estate investment trust, KRG, Kite Realty Group Trust. One of the reasons we looked at this today was a double buy rating. In fact, a strong buy from quant, very rare to see on this channel. A buy from Wall Street, a strong buy from Seeking Alpha. This is one that's in the mid to upper end of the 52-week range. Forward yield around 4.34%. P to FFO around 11.24. This is lower than the sector P to FFO. Over the last 12 months, hasn't really moved much, plus 1%. Over the last 10 years, if you have been a shareholder, well, you would be down around 10%. In terms of the dividend safety score, we'll take a look at this. It does sit at 60, borderline safe, and we do note it is a mid-cap company, around a 5 billion market cap. Now, we have seen that it was reaffirmed just a few months ago, this 60 score. Now, what this means, there is a moderate risk of a dividend cut over a full economic cycle. How did they do in the last recession? Well, not great, to be honest. They did cut the dividend, they did have below average growth, and they also trailed the S&P. In terms of dividend growth itself, well, their latest increase was around 4.2% in October. At a bare minimum, it is increasing in line with inflation, and we can see they did in fact cut that dividend in 2019, again during that pandemic in 2020. In terms of years though, they have been increasing those dividends for the last 3 years. When we talk about dividend yield theory, well, we can see it is looking reasonably valued, both the yield in line with the 5-year average as well as the P to AFFO. And when we do take a look, it isn't too dissimilar from the real estate of 14.6. Seeking Alpha, the website that we did just look at, did have a slightly lower number here. So again, do just bear that in mind. When we take a look then at the free cash flow payout, as always, for REITs, it isn't one we actually look at, due to the fact it is volatile in terms of free cash flow. So we focus on the adjusted funds from operation below 90%, 2022 64%, over the next 12 months around 68%, so no real worries whatsoever, significantly lower than the maximums that we do want to see. In terms of adjusted funds from operation, well, it has been decreasing over the longer term, not something we want to note. However, having said that, from 2020 where it did drop to around 124, it has gone back towards an upward trend, so that is nice. It is looking now like things have turned around for this REIT, and we can clearly see 2018 to 2019 wasn't the greatest period, but it has rebounded back. And in terms of the sales growth, 2022 115%, some incredible growth. 2023 it has started to slow down to 3%. Just bear in mind though, for REITs, when we do our deeper dives, we ideally want to see around 5 to 10%. So numerically, over the long term, we can see they have increased their top line. But what is very typical with REITs, we always say this, if you haven't seen our episodes, do check them out. They will dilute your position as a shareholder. Main reason for this, they don't retain a lot of that internally generated cash flow, as the majority is paid out in dividends. Some, however, will dilute your position at a much faster rate than others. In terms of the ROIC, well, for REITs, we want to see 3 to 5%. Very, very inconsistent, so do bear that in mind. And again, we will look at our margin of safety to determine whether or not this is something we do believe is sufficient. In terms of the operating margin as well, it has been decreasing, but again, we do note it has rebounded from the lows of 2022. 17% does still look very good. Then we move on to the net debt to EBITDA. For REITs, we do bring this up to around 5.5. Whilst the majority of the period it has been above that, nice to note it has finally come down in 2023, although expected to increase marginally over the next 12 months. We then move on to the valuation. Now in today's episode, we get to just above $25. We do see Wall Street, who forecast this upside at 14%, their price target marginally higher than our intrinsic value. And when we do come to our margin of safety at that 10% level, it isn't that far off, a few cents shy. So you could argue for this REIT, it does have a nice starting yield. Wall Street do see some nice upside as well, and we had both Quant and Seeking Alpha giving this a strong buy. As always though, do let us know your thoughts, as this is a REIT and maybe something that either is or isn't what you want to be looking at for your portfolio. We then move on to CRH, where we're on a bit of a roll with another rare strong buy from Quant, a double buy from the other two analysts. This is trading in the upper end of the 52-week range with a forward P looking around 15 and a trailing 12-month yield of just under 3%. In terms of its performance, well, very strong over the last 12 months, up 41%. Over the last 10 years, again, you would have outperformed the S&P, up around 213%. Now, it doesn't currently have a dividend safety score, so we will take a look to see the supporting metrics, but we do note their more recent dividend increase, very nice at 5%, again, above that inflation rate. On top of that, over the last 5 years, they have increased it double digits. Over the last 20, nice high single digits as well. And then when we take a look at that free cash flow payout, what we can in fact see, it is well below that 60% over the last 5 years. Over the next 12 months as well, 36% does still look very good. One of the reasons why we do notice that companies are able to offer some very strong dividend increases. We then move on to the free cash flow per share, again moving in the right direction, more than quadrupled over the last 10 years, but you do get some inconsistencies. One other thing to point out, it is expected to drop slightly over the next 12 months. In terms of sales growth, well, nearly double digits for the majority of the last 10 years, although we do see 2 years where it was negative, and when we zoom out and look at it numerically, we can see it has pretty much doubled over the last 10 years. In terms of shares outstanding, it looks like they may be a little bit confused. Some years they issue shares, some years they do share buybacks. Over the period, very, very trivial decrease of those shares outstanding. In terms of ROIC, remember minimum 10%. Now that is what they have achieved over the last 2 years. We also note that management have been getting better at this metric. Over the long term, it is also moving in the right direction. Same to be fair to be said for the operating margin. We do note some very strong operating efficiencies. But as always, a minimum of 16% is the ideal scenario. Free cash flow margin looking good. As always, minimum 5% is what we get here over the last 10 years. Finally, we move to the net debt to EBITDA. We can see a very strong balance sheet here. And again, this coupled with that free cash flow, this would likely have a very safe dividend score. 0.99 in 2023, although it's expected to increase over the next 12 months, still much lower than that 3 that we want to see as a maximum. So no worries whatsoever. In terms of the valuation, well, straight away our intrinsic value is not dissimilar from Wall Street's targets, and we do get a 31% upside over the next year. When we talk about margin of safety, then this must be a very nice MOS. 10% a buy at $96, at 20% around $85, and it's not quite at that 30% level yet. So in today's episode, you are getting a 25% margin of safety with some nice upside from Wall Street. As always though, do let us know your thoughts below. We then move on to a heavily requested stock. It is JD.com, and we get a strong buy rating from Quant. That is 3 in a row with a double buy from the other two analysts, trading in the mid to lower end of the 52-week range, a trailing 12-month yield of 2.7%, and a forward P just above 8. Now, over the last year, no surprises, down 25%. Over the last 10 years, you can see it is marginally up around 4%. Not the greatest of any investment. And we do know all-time highs sitting right there in February 21, around $103. The share price in comparison is much, much lower now. Again, no dividend safety score, so we can uncover what we would imagine it would look like. And when we take a look, the more recent increase, around 26% to the dividend. No surprises, because when we do come down to look at that free cash flow payout, we can see over the last year and over the next 12 months, it is anticipated to be around 21%. In terms of the free cash flow per share, it has been increasing over long term, even though it is fairly inconsistent. Some very large increases, or in fact fluctuations year on year. We do note a very marginal drop over the next 12 months. In terms of sales growth, this you could argue is a little bit of a worry, even though if you look at it in isolation, 10% in 2022, we can see it has been coming down very rapidly over the last 10 years. Is this going to continue over the next 10 years, or are they going to be able to at least maintain a minimum very high single-digit increase to their top line? Numerically, though, we can see it go up very, very sharply. One thing to note though, they would have diluted your position. Not only over the last 10 years would your return have been very poor, but you would have been diluted by a fair amount as well. We then move on to the ROIC. Well, what this denotes to us is that they haven't turned a profit from 2013 to 2018. From 2019, though, it is a little bit on the lower side, something just to bear in mind as we do look at the margin of safety. In terms of the operating margin, well, very small. Again, something just to flag here, 2% in 2022, 3% on a trailing 12-month basis. Free cash flow margin, whilst it is low, not too far off that 5% we want to see at a minimum. We then move on to the net debt to EBITDA, probably one of the better metrics of this company. 0 over the last 4 years, 0 over the last 12 months, 0 over the next 12 months, indicating it wouldn't even take them one day to pay off all of their debt net of cash on hand, and very likely this dividend safety score would sit around 99. We then move on to the valuation with an intrinsic value of $53. We can see, even though Wall Street very bullish on this with upside of 39%, it is still lower than our intrinsic value. The market current price of $28, we will have a very large margin of safety. At 10%, a buy at $48, 20% $42, at 30% $37, and we can see in today's episode you are getting at least a 45% margin of safety, but bear in mind the risk that does come with this company investing in China. But as always, do let us know your thoughts. A lot of people in the community will look to this and say it is very undervalued with a nice margin of safety, given the risks that are attached, political as well. A lot of people will say even if it was at 80% margin of safety, not something they want to touch. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts below, and we'll see you all on the next one.